Hello and welcome to the Global View on this Tuesday. I'm Andrew Gagan. Thanks for joining us again here at AusBiz as we get across those moves on global markets overnight. It was risk off as Iran hit several ships in the Strait of Hormuz and attacked a UAE oil port, sending oil prices soaring. Well, the escalation of hostilities in the Middle East saw stocks on Wall Street retreat from their record highs, as despite optimism about strong first quarter earnings reports. 10 of the 11 S&P 500 sectors declined, led lower by materials and industrials, while the energy index rose. Among the AI heavyweights, some of which have recently reported, Alphabet and Microsoft finished lower. And Amazon was among the best performers after unveiling a suite of logistics services that will let businesses buy existing freight and distribution offerings as a package. And that move sent shares of delivery firms FedEx and UPS sharply lower. Palantir beat estimates for first quarter revenue driven by rising demand for its data analytics software from the US government. Paramount Skydance's pre-tax earnings rose in the first quarter as streamlined operations helped offset declines in its television division. This follows the recent $110 billion deal Paramount struck to acquire Warner Bros. Discovery. Pinterest forecasts second quarter revenue above analyst estimates, helped by steady spending from advertisers as it sharpens its ad offerings with the use of AI. While language learning app Duolingo posted strong first quarter results but signalled a more measured growth trajectory. Shares in cruise operator Norwegian sunk after slashing its annual forecast due to higher fuel costs related to the Middle East conflict. And former meme stock GameStop has launched an audacious attempt to buy eBay for about $56 billion in cash and stock. Well, President Trump has launched a US Navy operation seeking to open the Strait of Hormuz to shipping, which has prompted an immediate response from Iran to keep control of the critical shipping route. 2 US Navy guided missile destroyers entered the Gulf to break an Iranian blockade, and the commander of the US forces said his fleet had destroyed 6 small Iranian boats, which Iran has denied. Iran retaliated, launching drone and missile attacks on the United Arab Emirates, including one that caused a fire at a key oil port, with the UAE saying it reserved the right to respond. Meanwhile, the US Federal Reserve New York President John Williams has said interest rates will need to come down, saying we will at some point need to be lowering interest rates to reflect the fact that inflation is lower. Inflation is higher this year than he previously expected, so that pushes off a date of lowering interest rates. US Treasury yields have jumped higher, the 10-year registering its biggest daily increase in 6 weeks, climbing to 4.46, the 2-year around 3.99%. The Australian 3-year government bond yields are around 4.7, the 10-year up to 5.06, with markets pricing in an 80% chance. The RBA cash rate will be hiked by 25 basis points today. US dollar index up around 0.33%, the Aussie trading at 71.7 US cents. Well, oil prices have jumped higher after the US Navy guided missile destroyers into the Gulf to break an Iranian blockade, prompting Iran to attack an oil port in the UAE. Brent crude up around 5.5% at $114 a barrel. Gold has fallen on renewed inflation concerns, spot gold at $4,520 an ounce. Copper's down 2%, iron ore at 110 US a tonne, and Bitcoin has eclipsed $80,000 for the first time since January. It's just come off a little since then, but it is up around 20% since the start of the war. Well, let's get across those movements on US markets. Dave Sekera is Chief US Market Strategist at Morningstar, and he joins us now. Dave, welcome back. Good to catch up for our monthly chat as we do. And of course, markets remain incredibly dynamic. In fact, we go back to your Morningstar outlook at the beginning of the year, and there was the warning there that this would prove to be a more volatile year. That has certainly panned out, hasn't it? So at the time, the recommendation was a barbell-shaped portfolio. How does that stand compared with what you're seeing now?
Well, if you remember, we did recommend that barbell-shaped portfolio, essentially looking for one half of the barbell to be very high quality, value stocks, specifically in the energy sectors. That was one of the most undervalued sectors coming into the year. The other half of the portfolio being those in growth stocks, specifically tech stock and AI stocks, many of which we saw being very undervalued coming into the year. Now, at this point, we did change our recommendation on the March 30th episode of The Morning Filter, which is my weekly podcast on Monday mornings. That's when I started to recommend harvesting profits in the value sector, specifically energy stocks. At that point in time, value was up 1%, Energy as a sector was up over 40% at that point in time, whereas growth stocks were down 10% and technology stocks in particular were down 13%. So we're recommending to reallocate those proceeds from those gains in value and energy and put those into those growth stocks, specifically the AI stocks and the tech stocks that have been beaten down over the course of the year. Now, since then, here in April, US stocks are up over 10%. We've had quite a rally. Growth stocks are up 12%, and tech stock is the second best performing sector thus far in April. That's up 17%, whereas value has lagged far behind. It's only up 3%, and energy stocks fell last month, down 5%. So where are we today? At this point, with as much as the market has rallied, the U.S. market's now only trading at a 5% discount at that broad index level. But we do still see value in both growth and value, both of those categories trading at a 7% discount, whereas core stocks are trading much closer to fair value. And then by capitalization, we still see a lot of value in small caps. That remains the most undervalued part of the marketplace, trading at an 18% discount today.
What are you seeing in terms of that dispersion in the market at the moment? Obviously, given the growth in those AI hyperscaler stocks, and of course that's off the back of recent results.
Well, the thing that's kind of surprised me the most this year is that while we were, saying that there's going to be a lot of volatility in the market, we haven't seen as much volatility at the broad index level as I necessarily would have thought at the beginning of the year. But that's really masked a lot of sector level rotation that we've seen ongoing throughout, the full year thus far this year. In April, really it's just all been about artificial intelligence. If you look at the communications sector, that's up 18% just in April alone. Technology up 17%. Those are both sectors being driven by those AI stocks. And even consumer cyclical, which is up 11%, the preponderance of the gains there was all about Amazon. So again, it's still all about artificial intelligence this year, really what's running the marketplace. To the downside, energy did fall 3% last month, and healthcare is off just a little bit, about 0.25%.
So let's, Dave, then focus on earnings season, what you've seen thus far, and very much dominated by AI, in particular the capex spending there, which is proving to be eye-watering, isn't it?
I think that's the understatement of the day. I mean, earnings expectations for AI coming into this earnings season were especially high, and they did not disappoint. Looking at the hyperscalers and some of those stocks most closely correlated with the artificial intelligence build-out boom, I mean, they beat expectations on the top line, they beat expectations on the bottom line, and in many cases just blew away, the market consensus numbers. But as you mentioned, we are still seeing a lot of these companies still increasing their capex guidance for this year. So still at this point, I mean, today is just the modern day version of the gold rush. Everyone wants that first mover advantage in artificial intelligence. Their biggest concern right now isn't not that they're spending too much. I think their biggest concern is still that they're spending not enough. They're just very concerned that any laggards in artificial intelligence will just end up, being those companies that'll be on the scrap heap of history, over time. I just would warn investors, you need to be very judicious in those companies that you want to invest in that are tied to artificial intelligence. Based on our evaluations, the most undervalued opportunities we see today are those companies that are the technological leaders within their AI, build out and respective products. Those that we rate with a wide economic moat, companies such as Nvidia, Alphabet, Broadcom are the ones where we still see value today. But the ones where I think you should be taking profits or even just selling out of positions outright are those commodity-oriented technology hardware companies, specifically those that we don't think have an economic moat. What we've seen really since last fall, but really accelerating this year, is that there's been just a huge undersupply in that type of tech hardware. The AI build-out boom has taken all of that supply off the marketplace, yet there's still a huge demand for things like memory semiconductors, optical networking supplies. And so those manufacturers are able to charge whatever price they want to charge. They're getting historical all-time margins on what they're selling now. It's just that at some point in time, with a commodity-oriented product like that, once demand starts to slow, that may not even be until, next year or even 2028. We know new supply is coming online. They're redeveloping a lot of their product lines. Some of these memory chip companies are already talking about, building new facilities. And once that supply comes online and demand slows, those high prices will come crashing down, margins will plummet, and I suspect that those stocks have a long way to fall at some point.
Dave, just running short of time, just a couple of stocks to highlight. The first one being Alphabet. Look, this hasn't been an amazing turnaround, hasn't it? Because it's seen as now leading that AI race. 2 years ago, it was a very different story.
Mm-hmm. Exactly. I mean, this was a company that people essentially left for dead a couple of years ago. They thought that search was going to be, forever left behind by artificial intelligence. This is a stock that's actually been one of our most recommended stocks on my podcast going all the way back to 2023. And just crazy strong performance. Looking at some of the numbers this past quarter, revenue was up 22%. I mean, that's a huge percent increase for a company that's already this large, getting good operating margin expansion, expanded by 220 basis points. Gemini API sales, we're estimating that's now at a $15 billion run rate this quarter. That's up from just $9 billion last quarter. I think there's a huge total addressable market still yet to come, in their artificial intelligence. And another one where, their first quarter capex spending was in line, but yet they boosted their capex spending for the year by $5 billion up to a range of 180 to 190 billion. So we're still looking for that acceleration in spending for the rest of this year.
Dave, just very quickly, Apple has been regarded as a laggard in that race. How do you see it now?
They also beat the top end of their guidance, revenue up 17% year over year. Very good revenue growth in iPhones. That was up 22%. Our analyst specifically noted that China was particularly strong. And again, their gross margins at 49.3%. That's a new all-time record for them. They're guiding the strong growth in the June quarter. Maybe a little bit of slight margin compression, but again, not enough to concern us. And in fact, we raised our fair value by 4% to 270 per share.
Dave, terrific to get across what you're seeing in the market at the moment. Thanks so much for joining us, Morningstar.
Thank you.
Let's now focus on the local market ahead of a big day here, with the focus very much on the decision from the Reserve Bank that is due to drop at 2:30 Eastern. And obviously the market is nervous about that. The prospect, certainly it's priced in that there will be yet another rate hike. So we are expecting a lower open. S&P ASX 200 futures, they're down 0.8%. Stay with us for the open.